Good morning, everybody. This is Kathy Elkins with Premier Marketing. And on the line with me today, I have Dana Brown. She's the senior internal wholesaler with I can't even talk this morning. Protective. Good morning, Dana. How are you?
Good morning. Thank you. Thank you for your time today, everybody.
Yep. Thank you, everybody, for joining us. Dana and I are going to be talking about, and I shouldn't say mostly Dana, is going to be talking about their Index Choice Universal Life today. Another good option when you're looking for index IUL plans. A lot of people are calling in and they're wanting these options. And then there's an extra bonus on this product because you can add one of their fantastic chronic illness living benefit products to it and get 100%, and let me make sure I'm saying this correctly, Dana, but 100% of the death benefit to be used for at-home health care, nursing home care, anything like that along the lines of chronic illness. To the 6 ADL. Am I correct? Okay. Which a lot of people realize these are on the market now and the clients are asking for it. So make sure you're having the conversation with your clients because they are hearing about it from either their neighbors, their relatives, or they've already heard about it from someplace else, but make sure you're having that conversation with your clients. So Dana, I'm going to let you take it away and give us the full details on this product. I love this product. It's a good option, and I love the writers.
All right. Well, that's right from the beginning, selling it. So thank you. So let's jump right into it with Protective. So the Universal Life product's been around quite a long time. So with any of our products, I'm just going to quickly spend 30 seconds to say, every time we design our products, and something you'll notice when you're looking at our products, is our names stay the same. So like we'll have our classic choice, our custom choice, our index product. This index product's been around for many years. Now, over the years, we've retooled it depending on the needs of the customers over the years. So you'll notice that that's something that Protective really, when they're designing products, it's for the long haul. So when you see version numbers behind it, and we're not changing those products a whole heck of a lot, that's intentional. We look at the big picture to keep our products in front of you consistently with making sure that we're not changing products, making it hard for you. We just want to make sure that you know it's very intentional, our product line. We really look at lapse protection, which we'll talk about in a little bit. That's something that is a great need in our industry, and you'll notice that there's other competitors out there that actually have kind of stepped away from like lapse protection products. So we've been around in the industry over 100 years, and you'll probably notice if you've ever been with Protective for any length of time, we actually have purchased blocks of business. So we've done a lot of, that's something we do really well is acquisitions. So, but Protective has been around forever. We look at trying to stay in it for the long haul. We design products for customers that are simple and easy to understand. And we're hoping that they're simple and easy to understand for you as well. So just a couple things with that. Let's get to the product. Okay, so like I said before, lifetime protection is very important for Protective. The Index Choice has a simple design. So we only have, in which we'll go in former slides, I might talk ahead. I'm sorry, it's just who I am. But it's one index, the S&P 500. So very simple. We're not dealing with a ton of different indexes. It's just that one. The guarantee on this particular product is guaranteed to age 90. But you can go and look on the cash value side, and that can go out for a very long time, all the way to 121 if you wish. And you can solve in different ways for this index product. So like I said before, the S&P 500 is who we use. That's it. The interest crediting, that's a bonus for any index product, is if you have an interest credited that's less than the floor of zero, then you are not going to get credited for any negative. So it would just hit a 0%. So if the S&P 500, for instance, all of a sudden hit a zero, a big goose egg, then you're not going to get or they could do a negative 6%, you're not going to get that. It's just going to be 0%. You just don't gain on that particular segment. Okay. One of the things we like about this product is access to future expenses or unexpected costs. You can get to the cash value. We do have an option 2 now That was as of July of last year. We added the option 2, which is an increase in face amount, and that's been a big deal for our customers if you choose the option 2. It's lapse protection through 121. That actually is not true. Sorry, that did change to 90, and I should have watched this, so I apologize. Lapse protection is only to 90, but you can actually do on the current side to 121. You can, let's see here, point to point with annual reset. So it's annual point to point, 2-year rolling target on this product to get paid for compensation. 8% cap rate, that is true. The max illustrated rate is actually 5.21, okay, in 100% participation rate. So I apologize, I didn't see that number hadn't been adjusted, so I apologize on that. So when you're talking about the index account, how do we credit it? Okay, so the 15th of the month, it will sweep into what we call the indexed account. Okay, so think of it this way. So you've got 12 months, right? You go and you say, I want, say you're ready to put a policy in force. And the way we work is we date our policies the 15th of the month, okay? So we'll just make it easy. So January 15th, say you've got a policy ready to go January 12th, and you have put a single premium in, we'll just say that, of $10,000. We will sweep it into, if it gets placed in force prior, we will sweep it into the index account on the 15th of the month, okay? If it's prior to January 15th, it will sweep on the 15th. If it's after that, so say January 17th, it wouldn't sweep into the index until the next 15th of the month. So that's an option. So it will create a segment. So if you pay like a lump sum, that's how it would treat it. It would sweep into that one segment unless you decide that you want to go spread that out, and you can actually do that. If you said, hey, I have a large lump sum and I want to kind of spread it out into 12 different segments, that is something you can do on this. It's called a monthly transfer. I would suggest doing that, especially if it's a large lump sum. And the thing that you don't know with segments, and this is true with any index product, you don't know until 12 months later when the segment comes due how your money's credited. So most situations is the S&P does great and you don't have to worry about the performance of it. But if you're concerned with a very large lump sum, I would suggest splitting out through the segments so that you can kind of spread that risk out a little bit. Haven't seen a ton where that's been too much of an issue, but I have had one case where they put a very large lump sum and they didn't get any negative, but they also didn't earn any credit to it, and that's something that you're trying to do in an index product. So just some things about that. And then this explains on the slide that, based on the segments, you could have a plus 13 or a negative 8 depending on how the S&P is doing. So by spreading the risk, that will give you the ability to kind of control that and help that with the customer. So just some things on that. Our current crediting rate is 3.25%. The guaranteed minimum rate that's on every illustration is going to be 1% guaranteed in the fixed account. You can split. Now, I don't see this too often, but you can split and say, okay, the S&P is not acting so great right now. I want to put half and half, or 10% in the fixed and the remaining 90 in the index. You can do that. You can illustrate that as well. So that's an option as well. So just talking about selling the zero real quick, all this does is that this will help you when say the cap rate's at 8%. It could hinder their cash value potential. So really the zero crediting floor can boost cash value to that much higher balance than the actual S&P without having to recover from any crediting rate losses. That's what selling the zero is. With IULs, something that we also do, which might be in a later slide, is if you're trying to look under the hood and compare us to other index products, it's good to go and take a look and run us at 3% or 5% even. When you do that with our low loaded product, that will kind of uncover if somebody's showing you a crediting rate of 9% and or 13% it was doing that a couple years ago, they've kind of changed that a little bit, so they're not making it as easy to do that. But you can kind of look under the hood. It's coming from somewhere. So if they're showing a very high cap rate, chances are their expenses are higher. So if you go and run a level 5%, a lot of times that allows you to look under the hood to see how many expenses are coming from that product. So just some things on that. Sorry, that was just something, an old, a guy that recommended our product and has still continued to recommend our product about selling that 0. So now I think Kathy, do you guys use WinFlex? I'm sorry, I might be putting you on the spot.
Yeah, we do.
WinFlex or ELI, which is our homegrown software. You can easily, all these illustrations can be ran on that. So when we're talking about, this is just an example when 0 is greater than 5, we kind of leveled it out so you guys won't know, who the competitor is. But again, it's looking under the hood, how it would perform. So if we're taking a look at the 4.55 interest rate, it guarantees to 84. If we're putting in a level premium of 12,420, basically you can see the cash value difference on that. 94,000 on the left, 151 at the 0% interest rate for cash value, non-guarantee near 20. So just kind of a comparison when we're looking at that between ourselves on this one. Let me see here. Okay, so like I said, strong product performance. We do really well with this. Last year we decided to retool it so the guarantee strength is to age 90. I will tell you that we're going to probably be the most competitive age 50 all the way to this, I would say 75. I mean, we're still looking better past that, but that's a good range where we're looking at adding both the Extend Care Rider, which I'll talk about in a minute, and the Index product. We're going to be competitive from Select Preferred all the way through our table ratings. Biggest strength is actually our standard through table ratings when you think of protective. So we've got a terminal illness on this product that's automatically included, no cost to that. Accidental can be put on here, child rider, the income provider option, which I'm not going to talk about today, that basically spreads the death benefit out in installments. But the one I want to talk about the most today, and I might switch presentations in a minute just to make sure we cover everything, is our Extend Care Rider. And that's why Kathy wanted me to talk about it a little bit. So as she said earlier, this is a great opportunity where a client can exercise for chronic illness needs their death benefit for those proceeds. Now, there is a cost for the Extend Care Rider. The good thing is it's controlled. So you're paying when you go and quote it, how much you want to price, which we'll talk about in a minute, it's already baked into that premium. And how we control it is the fact is you're only allowed to take as much death benefit that's available. Now, some thought process around this I want to say to you. Remember I said that there's an option too, right? So with the Extend Care Rider, there is an option. So say we don't know when a client's going to exercise it, but pretty much if you're looking in their 80s, they're going to exercise it late 80s, 90s if they decide to do it. Well, at that point, if they had chosen option 2, at the time that they go to exercise it, whatever their death benefit is in that given year is the pool that's available for them to use for Extend Care. If you choose an option 2, that actually might be a benefit to you. So for instance, if you started out with a $100,000 policy and you're 20 years in and say you're at $150,000 because you chose an option 2 and a face amount increase is how it's designed as an option 2, then you have that pool of money that's available. Okay. So how does it trigger? It's going to trigger like a long-term care rider. Okay. So with severe cognitive impairment and unable to perform 2 out of 6 ADLs. Okay. So indemnity method, all right? So we cut you a check. You can't perform the 206 ADLs. You go through the claims process, which is simple. It's a 2-page claim form where we basically have to agree that the client can't perform the 2 of the 6 ADLs or severe cognitive impairment. That's how long-term care is. All right, they go on claim. At that time, premium and policy expenses are waived while on claim. If their impairment lasts more than 25 months, which in most instances, I will tell you, most people, when they exercise the extend care rider, they're in it for the long haul. They're not coming off of it, I'll tell you. Does it happen? Yeah, it could. But for the most part, when they're going through the effort of going on claim, it's going to be of a permanent nature. Okay, so if they do that, if they go to 25 consecutive months, policy expenses are going to be permanently waived after that point, okay? Now, every 12 months, they do have to requalify, all right? It's the same thing, simple 2-page claim form, basically saying, yep, they still can't perform 2 of 6 ADLs, okay? Now, clients can specify the monthly amount chosen. Now, this is very important. You have to choose the highest amount that they're going to use at issue. They can always use less, but they cannot come back 5 years from now and say, I changed my mind, I think I'm going to need more. This product does not have an inflation rider on it. So you really want to choose the max amount that you can on this rider. So you can choose up to 5% of the face amount, and you'll notice the $3,000 to $12,000. It's actually, sorry, that's another thing that they've messed up. The per diem, there's something with that. So the per diem is actually $11,700. So this is not $12,000 this year. They ratcheted it down this year, and we are, to keep it, the chronic illness acceleration of death benefit, the 101G filing, which is the tax-free death benefit for this type of situation. We have to keep it under the per diem amount, which is $11,700 this year. It was $12,000 last year. Okay, so hold on, I want to skip here. You guys don't care about that. Okay, let me switch presentations real quick because I want to touch base on a sales situation for the other thing. So hold on one moment. All right, so we're going to step back for 2 seconds, just to refresh 2 seconds. What are the 2 of 6 ADLs? Bathing, dressing, toileting, transferring, continence, and eating. Those are the things that trigger it, or severe cognitive impairment, okay? Why do we think we need it? 52% of people turning age 65 will need long-term care insurance in their lifetime. This is a solution for chronic illness. It basically, in those situations, long-term care, there's certain rules around what you can take for long-term care. This fits in that scenario of if they can't perform 2 of 6 ADLs, but they're not really in a nursing home situation yet, if they need somebody to cut their grass, get groceries, or just care to help with certain things that they can't do right now, this is what this chronic illness will do. Of course, you can use it for long-term care as well, but it will fit in that area where you're not necessarily in a nursing home situation yet. So works great in that scenario. It also is controlled because you can only have as much as your death benefit is, okay? So with the life insurance and chronic illness rider, what it basically is, using the 101G filing, it's going to allow you to basically control expenses using death benefit coverage for various chronic illness expenses without receipts, okay? So once you go on claim, you don't have, that's the benefit of it. You don't have to submit receipts. We cut you a check. You use it for whatever you need. If you need somebody to do the mowing of the grass, cutting the lawn, cleaning up around the house, whatever, that's what it's for. Sorry, I keep skipping me here. Give me just a second. Go down here. I'm trying to get to this one right here. One moment. Sorry, I'm trying to get to her. If it's going to let me, guys. Hold on one second. Yeah. Okay. All right, it is let me here. So kind of the situations that would be for the chronic illness protection, it's good for that 50 to 60-year-old group. Um, if you're trying to work within a budget. So obviously it's, a long-term care policy is different. I mean, it is expensive. A lot of people get a little upset with the fact that, okay, it's a use it or lose it type mentality. With this is, if you don't use it, you're going to have a death benefit for your beneficiary. Okay. We also, it's good for that early range. I see a lot of people writing it 50, 60. You can write it younger. You can write it if they're 18 years old. I mean, we'll let you do it. The one rule around that is there are a couple of knockouts, same as long-term care. I can always share that with Kathy of what the knockouts are for this particular rider, but we can write up to a table 4. Okay. So again, it helps for retirement needs, cost-effective protection solution, not a use it or lose it. They can use it whether a death benefit or long-term care type situation. Also, too, I do see it in business owner situations for estate and legacy planning. We have to be in this situation, you got to be a little careful with the business owner. I would suggest making sure that you move the ownership over to the person individually if you were to go to exercise it. Because if you have it owned by the owner of a business or the company owns it, you really need to transfer it before you do that, because there's some tax things in here that you got to be careful of. So just know that I would separate and move it into the individual person's name before I went and exercised the rider. Not a problem, but I would do it so that there's not a tax problem there. Okay. Let me think. Kathy, is there anything else you want me to touch on?
I think you've been doing pretty good. We can do some question and answers and see if anyone's got any questions
Yeah,
out there.
let's
Please
do that.
go ahead and
Let's
type
do
up
that.
on the chat just to see if there's anything out there. I'm going to open up, Kelly, to see if you're out there, see if you have any questions or not, since you're on this with us. Hey, Kelly, can you hear me?
I can.
Do you have any additional questions that agents are asking you?
I don't, but maybe if you could go back to the crediting maybe and explain that again, just on a lower level, not such a high level.
Okay, are you talking about the index crediting?
Correct. Just
okay. Let me switch
because that
up.
seems to be the questions we get. That how is this credited and when, and if I look at this and okay, this S&P's performed at 8%. Does that mean I'm going to get 8% that year?
Yeah, so good question. I'm going to leave the blank screen because getting the PowerPoint will be a little difficult. But okay, so one thing that's available to you on our website is, and this is super helpful, and I promise you, I use it at least a couple times a month because it does come up. So with the crediting, so I took it as a global example of like a lump sum, and that, I would recommend a monthly level transfer. A lot of such times, how I see it is people pay a monthly premium, which that actually kind of treats as a monthly level transfer. So picture this. So you've got to have
your screen again, Dana.
Yeah, you're not going. Yeah,
okay.
No,
just making
it's
sure.
not going to be up here. Hold on. Let me see if I can get it for you. So the monthly level crediting. Yeah, I can get it here. Let me get over here. All right, bear with me just a second. Okay, so the MLT, so if you're paying monthly, okay, and say you're paying $100 a month, we'll just make it super simple, and I'm sorry, close your eyes for a minute till I get there. Basically what that means is every month in a year, there is a segment, and those segments keep continuing year after year after year, okay? So if you are a person that pays monthly and they're paying $100 a month, so it started, we'll say January of 2022. Their $100 went into this segment number 1 and will not mature until the 14th of January 2023. Okay, it will not be the 15th, it'll be the 14th. So we will find out a year from then from how that $100, if it got credited whatever percent the S&P did in that particular segment that ran January 15th till the January 14th of 2023. We won't know until January 14th of 2023 at the end of the day of how that performed. Okay, so that's segment one, month, and they're paying monthly. The next month, February of 2022, created another segment for that next $100 that was due. And we will not know until the next February 14th of 2023 how the S&P did for that $100. So I know I'm kind of giving a granular, a very broken down $100, very small, but that's a good way to spread out of how your money's being credited. Okay. Now you can do monthly. That's the easiest way to kind of explain how your money is credited. But when you go and do lump sums, like say you have a 1035 that's like $50,000, or how about 500, because that happened to me. And you go and say, okay, well, it actually swept into the account January 15th into the index. So I won't know until the 14th of 2023 how that money credited. So what I've learned, or what I advise people now after being in this product so long, is that we have what we call a monthly level transfer that will take that lump sum payment. You don't have to do this, but this is my preference. With the S&P sometimes fluctuating, I like to spread the risk when the lump sum is so great, because we won't know until next year how that money was credited. So that's just my own personal preference in dealing with this product a long time, and with the S&P kind of acting sometimes a little bit different right now. I would tell you to spread the risk out and do that monthly level transfer. So for instance, if it's a $50,000 lump sum, you could actually say, or design it, so you said, all right, I want $10,000 to go in month one, and then we can set it up so that each of that $10,000 until that $10,000 or $50,000 is exhausted can be spread out over, we'll just say 5 segments, because that's when the $50,000 would be exhausted. So that's how it works. It's literally almost like 364 days before we know what that particular segment is going to credit. Does that help? Can you hear me?
Sorry, bye. Yep. Kelly, does
Okay.
that help answer your question?
Yeah, I think that definitely should help some of the questions that we get, just, because it's like, how is this done?
Mm-hmm. And
So
two,
yes,
I'll
I
tell
think
you,
absolutely.
the guide on the website, so on myprotective.com, which is accessible to agents and myself and BGAs, it's all there. If you go to the index product guide, there's a place for agents that every month when the segments come due, we update this piece that tells you exactly how, from the inception of the product. So we're looking at, I think this product is over 7 years old. You can see from the very beginning how the S&P did in those different segments all the way back and then forward to today. So it's a good tool to kind of see how the S&P has been treating the product itself as well. So you can kind of plan, but I use the monthly level transfer for large sums a lot more than I did in the beginning. And a lot of it was because back when the inception of this product, the S&P, I would say, was pretty darn stable. And you'll see that when you're looking at that particular historical crediting rate report, you'll see what I mean. You're just noticing a little bit more volatility now in the last several months. That should level out, just because when we do a look back, we do 30 years. So, that will kind of give you an idea of historical crediting across the board. But yeah, I've noticed some more swings than I have in the last many years, in the last couple of months.
Perfect. I think that helped us quite a bit. Otherwise, we can call you and get some help if we need to.
Yeah, I can help you.
Good. I think you did really good with going over everything that I need you to hit on and touch base with. I've been taking notes over here. If anyone has any questions, please feel free to give us a call. You can reach out to myself, Kathy, or Kelly, 800-365-8208. Our team extension is 607. Again, Dana, thank you for being able to help us with this and being able to be here to help us today. Thank you, everybody, for joining. Have a great day.